Elevator Pitch with Jonathan and Mitch is made possible in part by Pearl House, a Van Barton Group holding, and by Commonwealth Land Title NCS New York.
Hi, I'm Greg Friedman, CEO of Peachtree Group, and I'm excited today to be here on Elevator Pitch with Jonathan and Mitch.
Welcome to Elevator Pitch with Jonathan and Mitch. I'm Jonathan Schein.
And I'm Mitch Berkey.
So Mitch, guess who's here today?
I know who's here. We have Greg Friedman in the house.
And Greg Friedman is the CEO of the Peachtree Group. We keep getting higher and higher, I'll tell you. So Greg, welcome.
Thank you. Thanks for having me.
Absolutely. So why don't we just dive right into the Peachtree Group? Why don't you tell us a little bit or a lot about it?
Yeah, I could take all day. So I don't know how much you want to know when you say all about it. I could tell you everything.
Well, in small bites.
Small bites, yeah. So, I started Peachtree back in 2007. So it's myself, I have two other partners in the business. But, Peachtree as a company is a private equity firm that invests across commercial real estate. So we invest very heavily within the hospitality space. So a lot of people know us for our equity investments in hotels. We also invest very heavily into the credit space, where we do a lot of direct lending across all commercial real estate property types. We do some lending outside of real estate as well. And we're known to buy a lot of debt from banks and financial institutions. We are vertically integrated as a firm, which really means we own a lot of different businesses that are set up to identify opportunity sets for us to invest into, to really optimize and drive the performance of the investments that we make. We operate assets internally. So we have operation companies, we have a lending platform, a development company, and so forth.
When you opened the doors in 2007, what was the plan then, and how has it morphed to what you are today?
Yeah, so it's in 2007, we probably had a plan of just owning a bunch of assets. We didn't really have I wouldn't say it was probably the most concise plan or the best plan, but this is before the great financial crisis. And this is back in May of 2007, just to put it in perspective. So this is literally
GFC came right on the heels of you opening the door.
Exactly. So we bought several assets right before the GFC occurred. So we were right on the heels of it. Didn't realize what was going to happen. But originally we thought we could go out and buy and develop assets, own them on the equity side, and almost be like a small family office where we were just going to own assets. We had no intention of operating assets. We were just going to utilize our own capital, myself and my partners. We were going to utilize our own personal capital along with friends and family. And then the great financial crisis hit, which we had to come up with a new plan. So it was like
How did you overcome that big challenge?
We effectively overcame it by going out and playing offense. So we looked at it two different ways. We said, okay, we've got to asset manage our existing investments, because at this point in time we had, eight or nine investments in different assets. So we had to asset manage and protect our investments there. So we had to play defense there. But we also said we got to go play offense and grow ourselves out of these challenges by going out and buying a lot of distressed debt, by buying assets at these reduced prices, which back in 2009, 10, and 11, assets were trading at huge discounts to the intrinsic values. And we took advantage of that both on the credit side as well as the equity side.
So you were buying notes essentially as part of the game. That wasn't your original game plan. You started off as an opco, I assume. without getting into the fund management business.
That's right. So originally it was, I wouldn't say we were an opco. Originally we started out as just almost like a propco in the sense that we were just owning properties, right? And then we quickly took back operations because of the great financial crisis. We fired our third-party operators because we hired third-party operators to run our hotels. So this was our first step into vertical.
Brought it all in-house.
We brought it in-house. That's right.
Yeah.
So that was our first step into being vertically integrated as a firm. And then we simultaneously, to your point, Jonathan, we went out and started buying up a lot of debt from banks that we had relationships with. And we're very aggressive into that trade. So we bought over 50 first mortgage loans in 2009, 10, and 11.
On 50 different properties?
50 different properties, yeah.
Any particular asset class, or you're looking more for what discount is represented in any given debt deal?
Yeah, so we were buying across all property types. So we bought everything, a lot of it was hotels because we really understand the hotel business. So probably 65, 70% of what we bought in that time period was on hotel assets or hotel properties, these branded hotel properties for the most part under the Marriott, Hilton, Intercontinental, Hyatt franchise systems. But we also went out and bought debt against like busted subdivisions. And to be candid, we should have bought all the debt on these busted subdivisions, all these land lots that were just sitting empty in the Southeast because we absolutely crushed it on those assets.
Was that for resi?
That was for resi. For developers to come in and build, or really for these builders, for these builders, residential builders to come in and build homes to sell. And we bought a bunch of land lot loans, that were sitting empty, these busted subdivisions, and made a lot of money on that trade as well.
So it was just land, you didn't do the BTR?
We didn't do the BTR, probably should have done the BTR. So we didn't do the BTR side, but we did, we did buy a lot of debt on these lots. And then we also did very well on the hotel side. We bought debt against like small office buildings, retail, against, again, all property types.
And at that time, were you taking over the interest in the property, taking over ownership, and then flipping them out?
Yes. So it's sort of funny because initially we thought we would. Like we thought we were going to go out and buy all these loans at huge discounts and end up owning the real estate. What ended up happening is over 90% of the time, we never owned the real estate. And this is how we started our direct lending platform, is that we found very quickly, as we were buying these loans at huge discounts, we could work with the actual borrowers, the owners of these assets. And it was a better outcome for them, obviously, because they stayed in the property, but it was a better outcome for us as well, because we worked with them, extended out these loans. In a lot of cases, these loans were in default, or they had maturity loan defaults, or they were in some level of default, technical default. So we did a loan restructure, kept the borrowers in place, and it was accretive for us because we were buying these loans at discounts. We got the benefit of those discounts as we, as they were able to pay us off. And that was a trade that was very successful for us.
This episode of Elevator Pitch with Jonathan and Mitch is sponsored in part by Pearl House, a Van Barton Group holding, and by Commonwealth Land Title NCS New York. Life at Pearl House shines brightly. It's where smart design meets condominium quality finishes. Pearl House, the beauty of smart living.
Commercial real estate is evolving, bringing new challenges and new opportunities. At Commonwealth Land Title National Commercial Services, New York, we provide trusted guidance, deep commercial experience, and seamless coordination on complex transactions grounded in local insight and backed by national resources. Commonwealth Land Title, NCS New York, trusted to move your most complex transactions forward.
With Peachtree, your main line at that point, other than buying the loans, the debt, was really in the hospitality side.
Yeah, that's correct.
And why did you choose hospitality based on your own history?
That's right. So myself, my partners, we all understood the hotel side. We grew up in families that, I grew up in a family that owned hotel properties, my family owned actually a lending platform that did a lot of financing for hotels. So I grew up around the business, personally, never worked in the family business. And then professionally,
You learn a lot at the dinner table growing up.
I learned a lot at the dinner table. When I say I never worked in the family business, I spent a lot of summers being cheap labor, where I was making nothing. Yeah. So stuffing envelopes and stuff. So you learn a lot, surprisingly, just by doing things like that. And so, I learned from the personal side. And then professionally, when I graduated from University of Texas at Austin, I went into banking for about 10 years, where I specialized in doing a lot of direct lending to hotel owners and developers and helping them capitalize projects. And so professionally, that's where I got my experience on the hotel side as well. So that's why we were so focused on the hotel industry, is that, myself, my two other partners, we all had a deep understanding of that industry.
Are you still with those partners today?
We're still together. So yeah. So fast forward, I guess 19 years later, we're still, almost 19 years later, we're still together and still, still doing, obviously we've grown our platform, still doing the same stuff I was about to say, but we're doing a lot more together. So
take us back. The three of you are having a beer, or you're out one night or many nights, and you're talking about opening up your own shop. How did that come to be?
Yeah, so it wasn't like it was just one night. This was something that started back in 2004. So, one of the partners and myself, we were looking to go out and buy or develop an asset together. So going back to 2003, 2004 time period, because we were friends going back into the late 90s, but we were like, wouldn't it be cool if we could just go out and start up, our own business by, developing a hotel or buying a hotel? And so for years, for, a good 3 years, we chased different potential acquisitions. We chased development sites to build. And then we finally found our first deal in 2007. And so it was one of those where it wasn't overnight, like everyone wants overnight success, right, especially you look at, like I'm sure as you see with the younger generation today, they all want, everything instant, especially with social media. But this was something that just took time. It took years and a lot of discipline on our side, because we actually lost a bunch of money together, putting down deposits and walking away from deals and spending due diligence dollars, and realizing we didn't want to, acquire that specific hotel property or even buy that specific development site, because we just didn't like what was happening in that submarket once we, studied it more.
You took your lumps and you learned from it.
That's right.
Some of your best lessons. So, we're going to jump around a little bit, but let's fast forward. You're in the hospitality business, right? And 2007, then you have 2008, the GFC. And then 2020 hits. And then you have COVID. And you're in the hospitality business.
Right.
And all of a sudden, nobody's going to hotels anymore. First of all, nobody has a plan for a pandemic.
Right.
How did you get through this? Because I think it's really important, because especially for a lot of the younger people in the audience, they're going to hit a crisis one day. They just don't know it. And you've been through two. So why don't you tell us about how you've gotten through these two cycles?
Yeah. So when the pandemic hit initially, no one really knew how long it was going to last. There was a lot of different opinions. And I sort of looked at it as this could be another, great financial crisis, a GFC type moment. And so I viewed it as a huge opportunity for us. I saw the challenges and realized that there was, a lack of travel, which was, in my mind, an artificial event that was, and I don't want to say artificial in the sense of trying to minimize the impacts. It had negative impacts on a lot of individuals, but it was artificial in the sense that it was going to be a short-term event. Like this was not going to be forever. Like at some point we were going to get through the pandemic one way or the other.
Financial crisis.
That's right. Like it wasn't and even a financial crisis, eventually you're going to recover. There's going to be a recovery. And if you can buy at the right time, like we did during the great financial crisis, you can make a lot of money. Go back to the great financial crisis, our original investments, we actually delivered incredible returns relative to what, other people experience. So you still can make good money going through a financial disruption or a pandemic or, other black swan events if you have the right investment thesis going into it. But the reality is your returns are probably going to be a lot lower than what you initially expected if you made those investments pre that, event.
But you still had the unknown. I mean, it was COVID, it was a pandemic. It wasn't like a cycle or a GFC type of event. So how did you navigate?
Yeah, so we quickly set up to go play offense to be able to buy investments. So I bifurcated the team into two different teams. One was for the offensive side to be able to go make new investments, to be able to buy loans, buy assets, on the cheap. And then we also, during COVID, had a separate team that was set up to asset manage. And they were focused on asset managing our existing portfolio and making sure we were, doing everything we could to really optimize the performance. At the beginning of COVID, there was no travel, so it wasn't much you could do other than try to minimize expenses and minimize the bleed.
Maybe get some PPP money or something like
exactly. Get PPP money, or even try to find other ways to reduce just operating costs. There was things like that. We raised liquidity internally We made sure we had appropriate liquidity to manage, through the pandemic. We also worked with our lenders, making sure we had the right, forbearance agreements, or, worked on the right structure, because we had no cash flows and we were going to trip up covenants. But we were very successful by bifurcating the team and having that mindset like we did going back to the great financial crisis, where we had offense, defense, and keeping that mindset where we could go put up points, in the sense on the offensive side, by going out and acquiring assets on the cheap, which we did during the pandemic.
Distress produces opportunity.
That's right. And it was a distress event that wasn't going to be forever. So we knew that this was an event that was eventually...
The assets weren't distressed. What was going on around them was distressed.
That's right.
Yeah.
So were you able to find opportunities? Because one of the big complaints during the pandemic was, it's a falling knife, but nobody was repricing. Were you able to still find opportunities during that?
We were. So we were very successful at going out and buying loans. So we bought over 180 loans secured by hotel assets and some other commercial real estate assets.
So 180 different properties again.
That's right.
Okay.
So we were very successful at acquiring debt positions on commercial real estate assets, primarily hotel assets, because hotels were, pretty much the most disrupted asset class at that point. And so we took advantage of that opportunity to make investments there. Everyone thought they were going to be able to buy, again, real estate on the cheap. And it was sort of the mistake in the great financial crisis. Everyone thought they were going to buy debt to own the real estate, and they were pricing accordingly, and they weren't able to successfully execute on that strategy. Whereas we quickly shifted our strategy in the great financial crisis to buy debt to restructure with borrowers, and we had a lot of success. We did the same thing in the pandemic. We bought debt with the idea of not owning the real estate, but being able to restructure and work with the borrowers. And that's part of the reason we had a lot of success in finding that stress or distress at that point.
Were the underlying assets, were they largely CBD, business travel oriented, or were they destination? What type of assets?
Yeah, so it was early into the pandemic, it was all markets. I would tell you what the commonality was: the banks that were selling. It was all the publicly traded regional banks for the most part, and some of the larger community banks that were publicly traded, because the public analysts, it wasn't the regulators. If you recall, there was a lot of just legislation that allowed banks to not have to, and really allow the regulators to give them breathing room, to not force them to have to,
There was a lot of nervousness about getting mark to market.
That's right.
Yeah.
So there was a lot of things that gave them coverage, gave the banks coverage in how they did restructures and, and worked with borrowers early into the pandemic. But it was the public analysts that had concerns about the long-term impact on these assets. And so they were the ones pushing these banks, especially the, regional banks, to sell off these assets. And we were able to buy a bunch of loans from the regional banks.
Were they most of the same flagships of the ones you already were operating?
A lot of them were the same, same type of brands. The Marriott, Hilton brands made up a large portion of the portfolio that we acquired on the hotel side.
This episode of Elevator Pitch with Jonathan and Mitch is sponsored in part by Pearl House, a Van Barton Group holding, and by Commonwealth Land Title, NCS New York. Life at Pearl House shines brightly. It's where smart design meets condominium quality finishes. Pearl House, the beauty of smart living.
Commercial real estate is evolving, bringing new challenges and new opportunities. At Commonwealth Land Title National Commercial Services New York, we provide trusted guidance, deep commercial experience, and seamless coordination on complex transactions grounded in local insight and backed by national resources. Commonwealth Land Title, NCS New York, trusted to move your most complex transactions forward.
Let's talk about the other side of the business, which is the credit side. And you have different streams of income through or revenue through that as well. I know that I think a big part of it is now production, movie production.
It's a small portion. I would say like when you look across our platform, we have close to $10 billion of assets under management, and the movie production financing is less than, say, 2% of our total assets under.
And when people hear movie production, they think, oh my gosh, what a sexy asset class.
That's right.
But I think there's a little bit more to it.
You're hanging out with George Clooney and
it's
the
that's
red
not
carpet.
case.
The red carpet.
Furthest from reality.
Right.
Greg was
It's furthest from reality,
so you were not
for
at the
sure.
Golden Globes this week.
That's right. I was not at the Golden Globes for sure. So it's more about financing the tax incentives and the distribution rights. So it's more of a receivable finance play than actually being in the movie industry or even taking on. Because we're not taking on the creative side risk, meaning you finance a film. There's certain lenders that will finance films without having tax incentives and without having any level of distribution rights sold off. And they're taking on that creative risk that if that film is a bust, they're probably never going to see their money back, or at least they're going to take a loss of some sort. Whereas when we finance a film, we already see that they've sold territories across the world out for distribution. And that's our collateral, along with the tax incentives being like tax credits in the various states across the US, like in New Jersey, there's a huge tax incentive for movies that are produced. And we've financed, a couple of films up in New Jersey that, have those tax incentives, as well as even financing films like in Georgia, where we're based out of Atlanta, Georgia, and even like in Australia, which has a huge tax incentive program as well. We've financed several films there.
Do you see that growing? You're saying right now it's a relatively small percentage. Do you see growth there?
I see the ability to grow at some level, but that's a space you got to be super cautious. It's very hard to scale. It's unlike real estate. There's so much real estate across the US. It's much easier to scale. We look at no telling how many different films to finance, and I would say probably less than 2% of the ones that we look at qualify for what we would finance. Now, it doesn't mean that we're financing it, but it's a very small percentage of what we would finance. And so it's very hard to scale into that industry without taking on risk that we're not willing to take on our side.
And do you have a specialist in-house that just specializes on that particular part?
We do. We have someone that runs that vertical for us. That's the president of that company that does the financing on the media side or the film side.
So going back to the more conventional debt product, your DNA is hospitality, but I believe you're lending across asset classes at this point. Is that true?
That's right. So we finance, I would say about half of what we finance today is in the hospitality space. Hotels make up about 7 to 8% of the commercial real estate ecosystem. So we have an outsized exposure to the hotel industry on the credit side. But even with that said, we finance everything from multifamily to industrial, retail. We finance even developers that are doing land lot development, horizontal development work. We'll finance that where they have a takedown agreement with like a D.R. Horton or some of the public home builders.
And are you looking at office at all?
We'll do office from time to time. It's a very small piece of our portfolio, as you can imagine.
What kind of office product would start to be of interest to you in this market?
Yeah, so ones that have a lot of good long-term credit tenants, that would be, that would obviously be an easy answer.
Right, you need to mitigate the risk elements.
But there's other ones that make a lot of sense that we finance where they're well located in submarkets where you have visibility into those buildings getting leased up, or if they have maturities, lease maturities coming up, you can at least see who the replacement tenants are most likely going to be, and you feel really good about your basis. And we've done a couple of those. We've actually bought some office loans as well, and we just got paid off on one a couple of weeks, or last week actually.
Now, would you prefer to be paid off on the loan, or would you prefer to go the loan to own route and take the asset?
I would always prefer to get paid off. It's always, the reality is loan to own. And there's certain cases where you have a business plan set up from day one where you're like, I'm going to end up owning this real estate. And in those scenarios, we're obviously, those scenarios typically work out very well for us. But when you're making a loan, if you end up owning the real estate, it's usually it's not to say that you're going to take a loss, but you're probably not getting the best return because you're going to have some challenges. You're going to have duration risk. You're going to end up owning the real estate probably longer, or you're going to be invested in the asset longer than you originally anticipated.
That's not your business model to own.
That's not our business model, but we do have the ability, if we have to take back an asset, what makes us different than your traditional bank or traditional lender is that if we have to take something back, we have a team internally that can asset manage, that can operate these assets so we can stabilize it. We're better suited to stabilize and asset manage a troubled loan than a traditional lender, given that we have so much knowledge internally on the real estate side and the asset management and operating side.
So you do buy these loans. Do you consider Peachtree rescue capital or special situations? How would you categorize it?
Yeah, so Peachtree as a firm, I mean, we're in the mispriced risk business. A lot of
Okay.
people like to say we're in the hotel business. People think of us as a lender. I call us, we're in the mispriced risk business. We're always looking for mispriced risk. So we're looking for opportunities where we can find mispriced risk. In a lot of cases, to your point, rescue capital. When someone needs rescue capital, it's usually mispriced risk because they need capital, they need liquidity in a very short window, and they're usually willing to pay more for that capital than they normally would be willing to pay. And if you can attach at a very attractive, level within that capital stack and get paid like equity, which in a lot of cases we do when we do rescue capital, because we'll come in as preferred equity or even provide maybe a bridge loan of some sort at some discount to the true intrinsic value of that asset, and we're getting paid like equity, it's really mispriced risk to our benefit.
So 23 and 24, your phone must have been ringing off the hook, as they say, especially with the way interest rates increased so rapidly.
Yeah. So it's sort of interesting because interest rates from 22 till now, right? Interest rates rose very quickly, and then you didn't have, like, historically speaking, when the Fed, rates rose by 400 bips, and then historically the Fed turns around and there'll be a rate cutting cycle, which did start, but usually the Fed will drop rates 300 basis points in the first 12 months of that rate cutting cycle. This time around, they only cut it like 100 basis points. And so it wasn't as effective on the recovery.
Enough.
It wasn't dramatic
Yeah.
enough. That's
Yeah.
right. And so the recovery has been very slow in real estate. But Jonathan, to your question, I mean, our phone was ringing off the hook, but it was very hard on the equity side to make sense of any of these investments, to buy any assets, to even develop assets. Has been a very challenging. I would say commercial real estate's been in a recession the last 3 years on the equity side. But on the flip side, us being able to invest through credit, we've been able to find a lot of opportunities in 2023, 2024 by making loans, providing first mortgage bridge loans, by buying loans from banks. Like even in 2025, we bought $600 million worth of loans from banks beyond providing a little under $3 billion of direct loan origination.
So on sourcing deals, we talked about the phone ringing off the hook. Do you find the deals are coming to you? Are you out there mining your Rolodex, to use that old school term? What's the dating ritual to get to a deal?
Yeah, so we have a team internally on the business development side, like the loan origination side, where I'm very big on outreach, going direct to banks, because banks tend to, when they're selling loans, they tend to like to work directly versus working through third parties, because they like to keep these processes very quiet. So having those relationships with banks and other lenders looking to sell paper, I'm big on having direct relationships with owners of assets that are looking for financing. So we have an origination team that's focused on calling on owners to provide financing to them. And then we work with a lot of third parties as well, different brokerage firms that bring us business. But we do the same thing on the equity side. We have a separate team that's out there actively looking for new investments. But because we've been around now for almost 19 years, we do get a lot of repeat phone calls from different financial institutions, from different ownership groups that we've done business with in the past. And the best marketing piece is having success executing, because when you have success executing, people see it. So yeah.
So as a percentage, you can say or not, but of all the loans you do acquire, what percentage do you end up owning?
It's less than, call it 3%.
Wow.
So like literally, when you look across the loans that we originate, the loans that we acquire, because as a company, we've made well over 800 investments, right? Yeah. We've made well over 600 investments on the credit side, and we've taken back less than 3% of the assets that on the credit side, on the investments that we made, either buying loans or making loans. And so it's a very small percentage.
This episode of Elevator Pitch with Jonathan and Mitch is sponsored in part by Pearl House, a Van Barton Group holding, and by Commonwealth Land Title, NCS, New York. Life at Pearl House shines brightly. It's where smart design meets condominium quality finishes. Pearl House, the beauty of smart living.
Commercial real estate is evolving, bringing new challenges and new opportunities. At Commonwealth Land Title National Commercial Services, New York, we provide trusted guidance, deep commercial experience, and seamless coordination on complex transactions grounded in local insight and backed by national resources. Commonwealth Land Title, NCS New York, trusted to move your most complex transactions forward.
So, you've been in business for 19 years. You've probably been in the industry longer than that.
Yep.
You've been through 2 pretty brutal cycles, plus the interest rate cycle. You probably have some young up-and-comers who have never seen anything like this before. How are you managing them through this?
Yeah, it's an educational process, right? Like I feel like a lot of people in real estate beyond our team, there's a lot of investors, a lot of groups that are run by organizations that haven't even been through, the GFC or 9/11, the dot-com bust, all the corporate scandals that took place back then, like with Enron. They haven't been through these different
They haven't been
markets.
tested.
They haven't been tested. That's right. And to y'all's original point, and really, Jonathan, I think you were the one that mentioned it about going through the pandemic. I mean, we've been battle tested as a firm. My background on the banking side, I've been through 9/11 and dealing with how that impacts a hotel portfolio.
And that was right on the heels of the dot-com bust.
That's right. And which, the dot-com bust really started before 9/11, as you recall. And you saw the performance in hotels, became very soft even before 9/11, going back to like March of 2001. But the reality is having that knowledge is huge when you're investing capital on the real estate side. It allows you to make better decisions. And it's one of those where you've got to help educate your team accordingly, because in some cases, they haven't seen some of the different things that can happen. And I would say most operators and developers and owners in real estate, a lot of them didn't, especially like on the multifamily side, they didn't really exist till post 2009. And all they've known is this 0% interest rate environment. Right. Until the last 3 years. And their expectation is we're going to go back to this 0% interest rate environment, which I don't see happening, like between 2010 and 2022. Exactly. Yeah, like 2010 to 2022, the 10-year average 2.2%. Today it's over 4%. And 4% is where we were, north of 4% was where the 10-year was pre-Great Financial Crisis.
That was the normal.
That was the normal. Yeah. That was a low, actually,
yes.
Technically speaking, when you look over time. So the 10-year has been substantially higher when you look over the last 60 years. And so it's not, I think it's one of these challenges where when people are underwriting deals, especially on the investment side, that's where you really see the lack of knowledge and experience when someone's putting some of the exit cap assumptions and not fully appreciating the sensitivity to if all of a sudden cap rates
now you're a sage
expand.
Veteran of the business, and you have to impart that to
right.
the young up-and-comers on your team.
That's a really good point, because you obviously, the whole idea is to future-proof the company and move forward. And I'd love to get your perspective on this, only because we're going in this direction. The baby boomers turned 80 this year, right?
Yep.
And Generation X turned 60 this last year. And so now we have all these up-and-comers, but there's all this blockage. And so how do you see yourself actually managing through that, as well as in the property types you're looking at? Are you starting to say, look at seniors housing, aging in place, those types of things?
Yeah, so senior housing is obviously very compelling for the stats you just mentioned. I think it's something that we would look at on the financing side selectively. It's not something we've done a lot of, historically speaking. But we're also sticking to our playbook on what works, because I still think some of the bread and butter type properties, like if it's multifamily, industrial, those are areas that we are looking to expand into at the right time on the equity side. It's an area that we're very focused in on the credit side over the last several years, beyond just hospitality hotels. And I see the hotel space, I feel like it's going to continue to exist. One thing that came out of COVID, because hotels was truly tested during COVID, as well as, every economic disruption, hotels are tested, like if it's 9/11 or the GFC, but it's always recovered. And the hotel space did recover. And I think long term, you're going to continue to see the desire for people to travel and see the world. So, yeah.
So we talked about senior housing. Assisted living, maybe it's the same, maybe a little bit different. I look at it as analogous to hospitality. It's got the real estate component. It's got the business component. Is that of any interest going forward?
Yeah, so there's no question there is definitely, it's similar to a certain point. Now there is some challenges with senior housing with like regulatory, issues that can come up with different types of senior housing. And that's part of the reason we've sort of just stayed away from it, because it is a little bit different and we don't have the expertise on the assisted living senior housing side as well. So like it would be the bar is much higher for us to jump in on the equity side until we can actually build out to be vertically integrated to attack that space, because that's more of an operating business, in my viewpoint, than say multifamily, which is, it's much easier to find great operators in multifamily, and it's much easier to operate multifamily. Hotels are very challenging to operate, and I would not feel comfortable being an investor in hotels without having that ability to operate assets, because that's a huge advantage when we're not only making loans, but as we're investing in developing assets as well.
And with the hotels, what markets are you typically in? Are you national, or do you look for certain regions?
So typically we're national, but we do look for certain parts of the country where there's higher growth long term. And so we like the Southeast, Texas, Arizona. There's a positive story there on the migration side. It's much more friendlier on the business side. So you're only going to continue to see growth in these markets from our perspective, from businesses relocating their headquarters or their offices into these markets, which is only going to cause more and more people to move into these submarkets.
I guess that means we should talk about Austin.
Love Austin. Hook 'em horns.
Yeah, hook 'em horns for sure.
A UT graduate. And did you get a real estate degree there? We're going to talk a little bit about your journey now. We're going to talk a little about
we
you.
need to get into Greg.
We want to learn about.
Yeah, like let's. So I didn't get a real estate degree at Texas. I actually got a biology degree.
Biology.
Yeah,
that's a natural fit into hospitality. Yeah.
Yeah, it makes a lot of sense, right? Yeah, like biology, I was going to be a doctor. So like.
Were you on the doctor track?
I was on the doctor
track. You are
track.
one of so many of our guests that were going to go to medical school.
Really?
Yes.
So what's the percentage of people that were going to go to medical school versus they were going to go to do real estate?
You'll have to watch all the episodes.
But
I guess I will have to now.
I'm going to say this, not one of them majored in real estate.
Really?
None of our guests have majored in real estate. Most of them were pre-med, pre-law. Some went to law school. But medical seems to be very high on our list.
Yeah.
But go back even further. Take us back to Tuscaloosa.
Okay. Yeah. So I grew up, outside of Tuscaloosa. So I grew up a huge Alabama football fan, and it ended up moving to Texas when I was 10 years old. So literally up until 10, I thought I was going to go to University of Alabama and loved everything about, living there, but ended up moving to Texas, to Dallas, and ultimately went to school at University of Texas at Austin.
Now, do people say you've totally lost the Alabama accent? Or are there a couple of indicators there?
So my mom has a very deep Southern accent. I just never got it. So like I don't know if I lost it or I just it never came. So.
And your dad is from Tuscaloosa also?
My father's not from Tuscaloosa. He's originally from New York.
Okay.
It happens.
Yeah, exactly. So
at what point was the move? How old were you?
So I was 10 years old.
Yeah. So you got your newly minted degree out of Austin.
So biology.
Biology. So I go to Texas at 17. So I skipped a year of high school and went to Texas with the whole idea I was going to become a doctor, and I was going to try to skip a year of college. Got to college and realized Austin's a great town. So like I had too much fun.
You majored in Austin.
I majored in Austin. I had great grades, but also had a great time just enjoying the university and the city, and ended up ultimately when I graduated from college. There wasn't, this is back in 1999. So it wasn't like there was a lot of, interesting jobs unless you're going to go do technology. All the tech companies were hiring. And coming out of Texas, you had to go into tech. You had to go work for Arthur Andersen, Enron. So two of those don't exist anymore.
Yeah.
So
or MCI for that matter.
Yeah. So I ended up actually going and getting a job at General Motors at GMAC Commercial Mortgage. Oh. And that's how I got an entrance into hotel lending.
Horsham, Pennsylvania?
Well, Horsham, Pennsylvania. I didn't work in Horsham. I worked in Atlanta, Georgia. Okay. So, yeah.
Why did you decide not to go to medical school?
It's a great question. So like I had a couple of different businesses in college, right? And so I started going down that track of business.
Entrepreneur.
So I was entrepreneurial. Yeah. And I was like, you know what? I love what I'm doing. I had a internet company. I had set up this portal to the web for college students. I was selling pagers back when pagers existed, and
Huge.
had a paging business, had vending machines. So I had all sorts of just entrepreneurial ventures. And I was like, I really don't want to go for another 4 years of medical school, right? Once you graduate college, and then you have to go do you end up having to spend another 4 to 5 years before you actually make any real money doing a residency and different things like that.
It's like another 10 years, you were making money now.
Yeah, it was like I was impatient. So I ended up saying, well, let me try to get a job. So I started looking at different opportunities and really didn't want to go into tech, necessarily. And so found an opportunity, because at the time I did have my, company that was a portal to the web for college students, this internet company. But I was like, you know what? I think I can make this work. I think it can be successful. I just need another year. My parents were like, you can do whatever you want to do, but you're gonna have to get a job. You're have to get a real job. So I started looking around and took a year off before going to medical school, and then ended up getting a job at General Motors. Fell in love with doing hotel financing, and never went back to medical school. So ended up.
And how did that go over at home?
It actually went over fine, because it's my family. They were in the hotel business. They sort of understood it. They, at first my grandfather was very anti the idea of me going and getting a job. He thought I should become a doctor first. And then
my grandson, the doctor.
The doctor. And my grandfather was very instrumental.
Still up in New York?
Oh, no. My father was from New York. My grandfather at this point was living down in Florida. So he was down in Miami, every Jewish grandfather living in Aventura, Florida. So you had to go. That's right. So. And so he was down in Florida at this point in time, and he was very anti going into the business force. He really believed you should have a medical degree or get a law degree, get some type of graduate degree.
Be a professional.
Be a professional, so you could always make a living no matter what's happening, because he grew up during the Great Recession or Great Depression. Depression. Excuse me. Yeah.
This episode of Elevator Pitch with Jonathan and Mitch is sponsored in part by Pearl House, a Van Barton Group holding, and by Commonwealth Land Title, NCS, New York. Life at Pearl House shines brightly. It's where smart design meets condominium quality finishes. Pearl House, the beauty of smart living.
Commercial real estate is evolving, bringing new challenges and new opportunities. At Commonwealth Land Title National Commercial Services, New York, we provide trusted guidance, deep commercial experience, and seamless coordination on complex transactions grounded in local insight and backed by national resources. Commonwealth Land Title, NCS, New York, trusted to move your most complex transactions forward.
Let's talk a little more about Peachtree. What are your future plans for Peachtree? What do you see for it?
Yeah, so for Peachtree, I see us being able to continue to grow and really take advantage of different, if it's market disruptions like we saw during COVID, or even what we're going through right now, which it's hard to define, maybe it's the great reset in commercial real estate. And then now we're going through this whole entire, all the political noise over the last year that's causing even more challenges with policies and things like that. But as there's these market disruptions, I see our ability to continue to grow and take advantage of these cycles and find, along the way, new products to launch and to really bolt onto our platform. Like, for instance, we're buying a lending platform right now that does SBA loans. Oh. So we're, growing into that space. We started our C-PACE lending program, commercial property assessed clean energy program back 7 years ago now. So we started that program, and organically we've grown it to where we have close to $2 billion of C-PACE loans on our balance sheet. There's been, over, I think, $10 billion of C-PACE loans originated since inception.
And are you servicing all of your loans?
We service everything internally. Okay. I see the ability just to continue to grow and add slowly new strategies, but really focus in on what works well for us, which is doing these credit investments across commercial real estate, where we're doing direct lending, buying loans from banks, and also, developing and acquiring hotel assets as well as other commercial real estate assets at favorable pricing when it makes sense.
Fascinating. So people who are watching this video series, or listening to our audio podcast. It's a fascinating story, the great journey. And whether they're starting out or they're in the business looking to pivot, they listen to your story and they say, how do I become Greg Friedman? What do I need to do? So do you have advice to impart?
I think the best thing they can do is become an Alabama football fan. No, but it's a great question. I think it's one of those where you got to be patient. Because I get asked the question all the time. People see the success that we've had as a company, and they're like, "I want to go start my own company."
I think it's immediate success.
Immediate success. It does
Yeah.
not happen immediately, and you can't force it. And you've also got to have the right. You got to set up the right infrastructure to grow and build a sustainable business. Because it's not about, like, when we started our business, we felt like it was always about finding that deal, right? Finding the right deal, and it is to a certain degree. You got to find the right investment. You can't lose money. You got to make money. Because if you're not making money, you're not going to stay in business long term, no matter what industry you're in. And when you're in real estate, it's about buying assets at the right price and being able to sell it. And you make your money on the buy side. I'm a big believer of versus when you sell it, because if you overpay on the front end, you're never going to make money. And so it's imperative that you have that mindset to a certain degree. But the other part of it is you got to build a sustainable business if you want to survive for the long term. So if you want to survive for 20, 30, 40 years, you got to be able to build a team. You got to be able to mentor a team internally and continue to have them be able to not only, grind and be able to go out and help assist on finding opportunities and being able to operate and asset manage, but you got to really be able to lead, and you got to be able to bring the right talent internally. And so there's a lot more to it than just finding, a great asset to buy. Because anyone can anyone really can go out there and find an asset to buy at a favorable price, but it's very hard to repeat that success. And that's what I feel like we've done at Peachtree is we've had repetitive success because we built the right systems, we have the right infrastructure, we have the right team members internally to have that success.
But you learned along the way, as you shared with us earlier. You took some lumps early on, and you learn from that, and you grow from that.
That's right. And that's where, you've got to learn. And no one really, when we started Peachtree, nobody said, look, you're going to have a corporate team of, call it 350 corporate team members that we have today. And you got to be able to motivate them. And then you're going to have a team of, call it close to 4,000 team members when you look at everyone across the hotels that you own. And you're going to have to be able to motivate and make sure that they're in the right place to be successful as well. And so it's, when you're setting up, you don't realize this. And I did learn and pivot along the way. I don't recommend that as the best way to do it. Some of it is you do have to, you can't, there's not perfection in setting up a business, meaning you're going to have imperfection on the front end, but you're going to have to pivot along the way. But I think you need to be very thoughtful and strategic if you're trying to set up the next Peachtree or set up the next great company, no matter if it's doing what we do in the real estate side, or if you're going into some type of other industry. It's all about having the right business plan on the front end and realizing that it's okay to pivot along the way as you learn more information. Because I think too many times people get stuck in their way and they're not willing to make pivots when all of a sudden there's a great financial crisis where we started buying debt.
To quote Mel Brooks, no one expects a black swan event. Right?
Exactly.
You started in 2007, which everything was wonderful. And 12 months later, it all goes straight to hell.
Right.
And so what do you do? That's, as Mitch said, that's where you start learning. It's easy to make money in a good time.
That's right. It's easy to make it in a good time. And it's like Mike Tyson, I hate to quote him, everybody's got a plan until they get, hit in the face.
Yeah. In the face.
So, right. Yeah. And then you've got to figure it out. And there's a lot of, you got to have a lot of grit, and you've got to have a lot of, you got to be resilient. You got to have grit. You got to be, used to rejection, because you're going to get rejected a lot, especially when you're starting a business in real estate, because there's only so much capital. If you're trying to raise capital, it's very hard it's a very hard industry to execute in. But once you're in the industry, once you're in that space, you can have a lot of success if you go about it the right way.
All right. Well, that's a good place to finish, but not finish.
Let's ask Greg a few things about Greg.
Yes.
What do you like to do when you're not working on big deals?
I love going and watching college football games. So I love this.
Is there room for another team other than Bama?
Texas is there too. So I watch a lot of Texas football games. Alabama football obviously is a big, college football I love in general. So I would say college football is the one thing in the fall that I will make time for. Like, I even go to other teams. I watched Indiana and Oregon play in Atlanta.
That was a great game.
Yeah, it was a great game for Indiana. Oregon, not so much, but it's. I love watching college football in general. Although the NIL is sort of changing my opinion there, but college football is a passion. And outside of that, I feel like I really love what I do on a daily basis. So it's somewhat crazy to think that I actually love working. So I don't mind working on the weekends or working late hours because I love what we do. And I love working with our team. We've assembled a great team and love watching them have success as well.
All right. So another question we like to ask is, can you tell our audience something that most people don't know about you? One thing that, a curiosity, as they would say.
A curiosity.
An exclusive for Elevator Pitch with Jonathan and Mitch.
Yeah, something people don't know about me. I would say probably, normally I'd be like a big Alabama football fan because we've already talked about that. But I'd probably say like a lot of people don't realize how entrepreneurial I was back in college. And we sort of talked about that today, but owning vending machines and actually having to go out there, had these stuffed animal machines and having to service them.
The one with the claw?
The claws, yeah. So
I never won
like,
one of those.
Yeah.
Were those things fixed? Or?
They were fixed to a certain degree. The claw,
So
the sensitivity on the claw would change as you put more and more money into it.
Yeah.
But they were very profitable because I bought these machines on a huge discount. They were used machines.
I always
But
wondered how that claw worked.
Yeah.
So just keep putting money in and eventually you're going to win.
Okay.
Right.
There you go. All
That's
right.
awesome. Are we ready for lightning round?
Lightning round.
Go ahead.
All right.
Now, these are questions. They're short questions. We look for short answers, so we get a little more window into Greg Friedman.
All right, let's go for it.
We're going to talk Bama right now. Joe Namath or Ken Stabler?
Joe Namath.
Okay. All right.
Okay, we'll stick with Bama. Nick Saban or Bear Bryant?
Nick Saban all day.
All day long.
Yeah.
Okay.
All right. Here's a curveball. When recruiting, Austin or Tuscaloosa for your team?
I would say for our team being Peachtree, I'd say Austin.
Okay.
And who's got better ribs, Tuscaloosa or Austin?
I would say Tuscaloosa.
Wow.
Wow. All right.
I think we could leave it almost right there.
Well, Greg Friedman, Peachtree Group, CEO of Peachtree Group, thank you for joining us on Elevator Pitch with Jonathan and Mitch.
It's been a pleasure, Greg. Thank you.
Thank you.
This episode of Elevator Pitch with Jonathan and Mitch was made possible in part by Pearl House, a Van Barton Group holding, and by Commonwealth Land Title NCS New York.